Hello everybody, Nick Fenton here, in-house options expert for Likefolio. Very excited about this particular video. Iron Condors and Strangles. We're looking at selling Iron Condors, selling Strangles. These are two strategies I hold near and dear to my heart. They are strategies I utilize very often, especially short Strangles, and you'll see why I prefer those over short Iron Condors shortly. But we're going to be looking at how to incorporate social sentiment and implied volatility into your decision making, and how to choose the proper legs for these particular strategies, how to choose your duration period, how to analyze the trade so that you can get a decent visual on the Analyze tab. So we're going to be going over a lot of stuff in a short period of time, so do your best to stay up with me. So we just want to mention here, as always, social sentiment is only available in Thinkorswim. Thinkorswim is brought to you by TD Ameritrade. If you don't have a TD Ameritrade account, definitely get one. There is no doubt in my mind, Thinkorswim is the best trading platform out there for options traders. Don't hesitate. Sign up for TD Ameritrade account. We have a great offer for you at the end of this video. Stay tuned. So for now, refresh here. To make sure that you have social sentiment on your chart, you want to go up here to Style when you're in the Charts tab. You want to go to Settings, and then go to the Equities tab. Make sure that Show Social Sentiment is checked. And then in order to get this implied volatility study that we have at the bottom of the chart here, you would go to Studies, Add Study, Volatility Studies, and you would choose Imp Volatility, which is not showing here because I already have it selected. But it's right around here. So, without further ado, let's discuss the Iron Condor trade strategy and the short Strangle trade strategy. Both of these strategies benefit from the price of the underlying or the stock that you're trading options in, staying within a specific range. So right here we're looking at Lululemon Athletica. When I take a look at the price chart, I see that the stock has seen some significant downside pressure, but looks like it's taken a nice little breather here. We have earnings coming up in a couple weeks. Well, actually about a month, which is perfect because we only want to be in this trade about 20 days or so anyway. So we won't have to hold through earnings. We've got this range-bound action taking place. I'm thinking it's probably going to take this breather all the way into the earnings, maybe see a little bit of up or downside pressure. But I really like this range that it's currently sitting in. The top end of the range is right around 59. The bottom end of the range is right around 55. So we've got a really tight range going right now. I could see that widening to maybe 54.60, something like that. So if we can get a trade that benefits from it staying in the 54.60 range or even better, then we're in good shape in my opinion. So there's what the price looks like, from the price chart. Let's take a look at social sentiment and see if it backs up neutral sentiment. So the first thing I notice is when you smooth out the sentiment data, which is located here in the orange line graph, when you smooth it out, it really has just kind of stayed fairly neutral. We get dips below this bottom line on occasion and dips above this top line, but for the most part, it's kind of staying within this specific range here. With regard to positive sentiment, we have seen a little bit of downtrending going on here. If you look at those peaks, and then if you kind of take those peaks out of the equation, then you can still make an argument for a slight downtrend. So, if anything, this might see a little bit of downside pressure in price based on the social sentiment here. But all in all, this is pretty neutral. There's no real defined downtrends. We can't really force a downtrend here in sentiment. I guess you could say that there's a slight bearish tone to this most recent sentiment, but all in all, when I look at this, I really just see more sideways than I see any directional bias. So I'd say that's fairly neutral with a slight hint of bearishness. And when we look here at the implied volatility chart, we want to make our two observations here. What's the peak of the implied volatility on the 52-week period? Well, it's right here. It's around 70%. And what's the bottom? It's right here. It's around 10%. those two seem to be anomalies for the most part. So let's see, what's a more common peak? Well, I'd say right around this 55% area is much more common than that one blip we saw up at 70. And right around this 25% area is much more common than the 10% blip that we saw. It was just a real quick dip down to 10%. So, the absolute peak is 70, more common peak 55. Absolute bottom would be 10%, more common around 25. Currently we're around 42. That's kind of dead center with a little bit more favorability towards the top end of the range. So since we're closer to the top end of the range than we are to the bottom end of the range, that insinuates that it's more advantageous to sell premium rather than buy premium. So that kind of gives us the opportunity to look at selling this Iron Condor because we're looking at a neutral bias situation with the implied volatility in a more advantageous position to sell premium versus buy premium. So let's take a look at building an Iron Condor first, then we'll take a look at a Strangle. So we come over here, and the first thing you want to do is choose your month. I like to be in between 40 and 70 days. I've already chosen this December 16, so that's going to be the one we play with. The reason I chose that is because, like I said, I like to be between 40 and 70 days. The Jan 17s are 79 days away, which is just a little more time than I like, a little more duration than I like when I'm selling premium. And then these weeklies, I prefer the standard monthlies because there's more liquidity in these standard monthlies. When you see this weeklies, you really want to double check liquidity. So this one's right in our range, 44. It's toward the bottom end of the duration preference. Again, 40 to 70 is the window I prefer. So we're going to choose this one with 44 days left. That's what this 44 means. 44 days left until expiration. They're the December 16s. That means it's going to expire on the 16th day of December 2016. So now we need to choose our legs. And what I do first is I choose my short leg. Now you need to change your layout. Currently I've got this layout, volume, open interest, probability in the money. In order to match this layout that I have, you would just go over here to layout, customize. You're going to remove whatever you have in your current set. So you would highlight it, hit remove items. So we'll just remove volume just for educational purposes here. And then you find whatever you want and we'll go back to volume. You can double click it. You can highlight it and hit add items. I'm just going to double click and it puts it there. I want it to be at the top. So I'm going to highlight that, move up. So I like this order: volume, open interest, probability in the money. So make sure that your sets reflect volume, open interest, and probability in the money. Here's why. First thing we want to do is figure out which leg we want on the short side, on the put side. I like my short leg to be pretty close to 30% probability in the money. So here's our probability in the money column right here. And if we look at the 52.5 strike, you can see it's 28.32% probability in the money. That's really close to our 30%. So I'm just going to click on this and we'll just highlight that for later. All right, and then on the call side, we want the same thing. We want the short leg that's closest to 30%. So here we've got 62.5 strike at 28.84%. That's really solid. So I'm going to go ahead and highlight this as well. All right, so we've got both of our short strikes highlighted. So we're looking at the 62.5 call, the 52.5 put. If we go over here, I mentioned if we could get anything between 55 and 60 range or better, then we're in good shape. Well, it looks like we got the or better end of the bet here because we're looking at the 52.5 short put and the 62.5 short call. So basically, we're just saying the stock needs to stay within that range, 52.5 to 62.5, in order for us to achieve max profit. Well, in order to get some protection here, we need to buy some outer legs. Otherwise, we're just sitting here naked, which would be a strangle. So first thing we want to do is decide, how wide do we want our spread to be? Do we want 52.5 in the 50s, which would be a 2.5 wide, because the difference between 50 and 52.5 is 2.5? Or do we want a 5 wide, which would be selecting the 52.5 and 47.5? I'm going to go with 5 wide here. Just put us a little more risk on the table, but gives us a little more opportunity for profit. So 5 wide it is. So first thing we want to do in order to build our Iron Condor is you can go here to make it simple. You can go here to spread and you can choose Iron Condor. That's one way to do it, and then you would simply click on the one that reflects your situation closest, which would be this one right here. And then you have to modify all the legs. I don't like doing that. I prefer to keep it on spread single. And what I do is first I'll click on the short put that we selected, which was this 52.5, because that's the one that's closest to 30 probability in the money. So you click on the bid because we're going to be selling that one short. Then I scroll here and I go to the 47.5 because we're doing 5 wide, and we want to click on the ask while holding the control key. So you see when I click the control key, all these numbers pop up at the top. When I let it go, they go away. So you just want to make sure you're holding the control key. And when you click that, it's just going to add this into the trade. So it's nice and convenient. Then we want to go down here to our 62.5, and we want to look to sell that 62.5 because that was the one we were talking about selling short. It's closest to 30% probability in the money. Again, hold the control key down and left click the bid because we're selling this call short. And then continue holding the control key. And we're doing 5 wide on the call side because we want this to be balanced, 5 wide on both sides. So we're going to buy the 67.5, which is 5 points away from the 62.5 that we're selling. So we'll click the ask on the 67.5 calls. And you'll see down here, now it's automatically recognized that we have built an Iron Condor here. So we're selling, I'm going to change this to 1. We're selling 1 Lulu 16 December 16 62.5 call. We're buying the 67.5 call. So here we have a short call spread. And then we're selling the 52.5 puts and buying the 47.5 put. So here we have a short put spread. So all an Iron Condor is a combination of a call spread and a put spread. So you're selling them simultaneously. If we right click on this and hit Analyze Trade, it's going to take us to the Analyze tab, and we just want to make sure, so now we're on the Analyze tab, we want to make sure we're in the Risk Profile area. Risk Profile is going to give us this nice risk profile chart. I'm just going to shrink it up here so we can see everything nice and clear. So now we have our risk profile chart. Basically on this chart, the y-axis is your profit loss. So 0 is break even. Anything below 0 is our capital loss. Anything above 0 is capital gain. And then our x-axis is the price of the underlying. So different prices of this underlying, starting from 44 going all the way to 72. So the price of Lulu is reflected here in the x-axis. First thing I want to do is click on this button here, Show Actions Menu. Go to Set Slices, and I'm going to set them to break even on the expiration date of the options that we're utilizing here. So 12/17/16 would actually be the day after expiration. So they expire on Friday the 16th. This 12/17 would be Saturday the 17th, the settlement date. So these are completely settled out on Saturday. So that moves our slices here right to the break evens. So we have one break even here, one break even here. These dotted vertical lines represent our slices. So now our slices are on break even. So you can see the lower break even here is 50.55. It's showing us it's 50.55. So the low end of the break even is 50.55. The upper break even is 64.4. It should be 45. So 64.44, somewhere around there. What we can do here to get a visual of what this looks like on the chart is we can right click that, or left click that show actions menu again, and we can choose slices to chart. And we just want to see this on one chart, so we choose the single square on the top left that's already highlighted. So you click that, it takes us right over to the chart, and these solid lines are our break evens. So you can see here, as long as Lulu stays within this range, this is a profitable trade. So the range is represented by this upper break even and this lower break even right there. So that's our range. As you can see, that range exceeds the range that we were hoping to see. So this looks like a pretty solid trade. And what you do here is you sell the trade. You can see down here, I'm going to right click and create duplicate order. So essentially you're selling the trade for $1.94 credit. If the trade expires worthless, you want this to decrease in value because you're selling it. So if it is to expire worthless, you'll make $194 per spread. And so that's a pretty solid amount of capital. Generally, I take them off after they've decayed about 50%. So in this case, once the value of the credit decayed to about $1, I'd be taking this position off, taking profits. So I'd be looking to make about $94 per spread here. So the question is, what am I risking to make that 94? Well, the risk profile is going to answer that question for you. You can see here at the top end of our max profit range, we can make $194. Our worst case scenario down here at our worst case loss is $306. So we're essentially risking $306 to make $195. But in my case, I'm going to be taking this position off at $1. So I'm risking 300 to make 100 basically. So risking 3 to make 1, not exactly the human intuitive approach. You're always taught to risk less to make more. I take the complete opposite approach. I risk more to make less with a higher probability of success. Speaking of probability of success, right here, 58.63 is the probability of having a successful trade in this particular instance. So let's compare this to a short strangle. We're going to go back to our trade tab. We're going to build a short strangle this time. Now, similar way of choosing legs. I'm going to stay in the same month, 44 days of duration. Similar way of choosing legs. I like to really rely on the probability and the money. But I like it to be as close to 16% as possible. So that gives me about 1 standard deviation out of the money on both sides. So in this case, 13.2, I like to err on the side of lower than 16% versus higher. So 19.84 would be a little far above 16. So I'm going to err on the side of going below 16. So I'm going to click on the bid because we're going to be selling the 47.5 put. So I'm going to click on the bid of the 47.5 put. Same thing on the call side. It's already got it selected here. It's 67.5. That's probability in the money of 13.1%. Better option than our 19.7% in my opinion. So I'm going to hold control. Got to hold the control key down, left click the bid on the 67.5. Again, down here it's recognizing that we've just built a strangle. The strangles can be sold for $1.17, so the credit's a little less. Let's right click and analyze the trade. So down here we are showing two different spreads. We've got our Iron Condor, we've got our Strangle. Let's uncheck the Iron Condor so we can exclusively look at the Strangle. So here we have our slices from the Iron Condor remaining on our risk profile. Here's our first horizontal slice, that was our upper break even, and here's our lower break even. Well, here's the break even, lower break even for the Strangle. So you can see how much wider the Strangle is. Here's the upper break even for the Iron Condor. Here's the upper break even for the Strangle. So much wider. Let's see what it looks like on the chart. So we go down here, left click on Show Actions menu, set slices to break even. We choose our 12/17/16 date. That's the settlement date for this options month that we've selected. So that puts our slices, moves them all the way to the break evens for the Strangle. And then let's go here, set slices to charts, choose that top left square, and boom. Look how wide. So this oval represents the range that we had with the Iron Condor. Now we're talking about an even wider range with our short strangle. So I'll just make a thinner oval here to represent the range. I mean, look at that. You sacrifice your protection via buying the outer legs in the Iron Condor in exchange for getting a much wider range. And that wider range gives you a higher probability of success. So here we're looking at 81.13% probability of making a cent or more technically. But generally 81.13% probability of having a profitable trade in this position versus what we had in the Iron Condor, which was 58%. So we've seen a dramatic increase in probability of success. The Iron Condor was solid, 58% was solid. 81%, that's killing it. That's killing it. This is exactly why I prefer this particular strategy over the Iron Condor. The downside to the strategy is if we look over here, so here's our profit loss. Max profit is right here at, it's saying 1170. Let me change to a one lot so we can do apples to apples with the Iron Condor. All right, so right here, $117 would be our max gain. And that takes place between the short strikes that we sold, 47.5, 67.5. Once we go below 47.5 on the low end, we start losing money until we hit our break even, which is right there at about 46.35. Once we go below the break even, the losses start and they go pretty quick. And they're pretty much unlimited on the upside. Your losses are limited to the stock going to zero on the downside. So that's where your real risk is. But I personally am very comfortable with the risks associated with this particular strategy. I've had much success. Again, I would cover this position at about 50% value decay. So I'd be looking at covering this one at about 60 cents. If this $1.17 credit down here was to decay to 60 cents, let's create a duplicate order. So $1.17 credit was to decay to 60 cents, I'd be taking profits on this position. So I know this is a lot to digest. It's a lot of information I just threw at you. I encourage you to watch this video more than once, take notes, play with your Thinkorswim desktop trading software, replicate all the moves that we've done here today, and it's just going to get you one step closer to being a really strong trader. In the meantime, I think I'm going to put this short strangle on because this is a really good trade. I'm loving it. A month out of earnings gives me a good 20 days to see some time decay. If it stays in that range, then we're going to see some pretty quick profits taking capabilities or opportunities, I should say. And this is looking like a really good trade. I love the social sentiment addition to the Thinkorswim platform. Now I've got two forward-looking indicators here that I can rely on, and Implied Volatility is telling me it's a good time to sell premium. Social sentiment is basically giving me, strengthening my case that this is a neutral bias. It does have a slight bearish tint to it, but I've got plenty of room with this Strangle for bearish price action, so I'm not too worried about that. Hope you enjoyed the video. Take care. Special pro tip alert. Visit learn.likefolio.com. We've got more Likefolio Trade School videos, all exciting, jam-packed with education, beneficial, actionable, awesome. Also going to have a special brokerage offer for you, so make sure you visit.